Question 1. Market research demonstrates that a significant portion of disability income insurance claims are linked to occupational hazards. An underwriter is reviewing an application for a disability income policy from an individual who lists their occupation as construction manager. The underwriter has access to standard occupational codes, but is aware that the specific duties and work environment can vary significantly within this broad classification. Which of the following approaches best aligns with best practices in occupational underwriting for risk classification and hazard assessment within the regulatory framework governing disability income insurance? Option A. Rely on the applicant's self-assessment of their risk level, accepting their stated opinion on the hazards they face in their daily work. Option B. Request a detailed job description from the applicant, including information on the percentage of time spent on-site versus in the office, the types of construction projects managed, e.g., residential, commercial, heavy industrial, and any specific safety protocols or personal protective equipment typically utilized. Option C. Assign a standard risk classification based on the General Occupational Code for construction manager without further inquiry, assuming the typical duties and hazards associated with this role. Option D. Classify the applicant based on the perceived prestige or income level associated with the occupation, assuming higher income correlates with lower occupational risk. Correct answer is C. Assign a standard risk classification based on the General Occupational Code for construction manager without further inquiry, assuming the typical duties and hazards associated with this role. Explanation. This scenario presents a professional challenge because accurately assessing occupational risk for disability income insurance requires a nuanced understanding of an applicant's duties, the inherent hazards of their profession, and the potential impact on their ability to perform their job due to illness or injury. Misclassification can lead to adverse selection, where the insurer attracts a disproportionate number of high-risk individuals, potentially impacting profitability and the ability to offer competitive products. It also raises ethical concerns regarding fair pricing and equitable treatment of policyholders. The correct approach involves a comprehensive review of the applicant's specific job description, considering factors such as physical demands, exposure to environmental hazards, stress levels, and the potential for repetitive strain injuries. This detailed assessment, aligned with the insurer's underwriting guidelines and relevant regulatory requirements for risk classification, allows for an accurate determination of the occupational hazard rating. This ensures that the premium charged reflects the actual risk being underwritten, adhering to principles of actuarial soundness and fair competition, as mandated by regulatory bodies overseeing insurance practices. An incorrect approach that relies solely on broad occupational categories without delving into the specifics of the applicant's role fails to adequately assess individual risk. This can lead to either undercharging for high-risk individuals or overcharging for low-risk individuals within the same broad category, violating principles of equitable risk distribution and potentially contravening regulations that prohibit unfair discrimination in pricing. Another incorrect approach that prioritizes speed of underwriting over thoroughness by making assumptions about job duties without verification risks overlooking critical hazards. This can result in inaccurate risk assessments and, consequently, inappropriate policy terms or pricing, which could lead to future claims disputes and regulatory scrutiny for failing to adhere to underwriting standards. A professional decision-making process for similar situations should involve a systematic evaluation of all available information, a clear understanding of the insurer's underwriting philosophy and guidelines, and a commitment to adhering to regulatory mandates. This includes seeking clarification on ambiguous information, consulting with experienced underwriters when necessary, and documenting the rationale for all underwriting decisions to ensure transparency and accountability. Question 2. Stakeholder feedback indicates a need to clarify the application of the waiver of premium benefit when an insured, who has been approved for disability income benefits, subsequently returns to part-time employment. Considering the regulatory framework for disability income insurance, which of the following approaches best ensures compliance and upholds the integrity of the waiver of premium provision? Option A. Interpret the waiver of premium provision in the most restrictive manner possible to minimize insurer liability, even if it contradicts the general intent of the benefit to provide relief during periods of disability. Option B. Deny the waiver of premium benefit outright because the insured has returned to any form of employment, regardless of whether it aligns with the policy's definition of disability or the insured's residual earning capacity. Option C. Immediately cease premium collection and confirm the waiver of premium benefit is active solely based on the initial approval of disability income benefits, without further investigation into the insured's current employment status. Option D. Conduct a detailed review of the policy contract to ascertain the specific definition of disability and the conditions under which the waiver of premium benefit remains active or is terminated, considering the insured's current part-time work status in relation to their ability to perform substantial and material duties. The correct answer is D. Conduct a detailed review of the policy contract to ascertain the specific definition of disability and the conditions under which the waiver of premium benefit remains active or is terminated, considering the insured's current part-time work status in relation to their ability to perform substantial and material duties. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how policy provisions interact with an insured's evolving financial circumstances, specifically concerning the waiver of premium benefit. The core challenge lies in balancing the insurer's contractual obligations with the insured's need for continued coverage during a period of disability, while adhering strictly to the regulatory framework governing disability income insurance. Careful judgment is required to ensure that the application of the waiver of premium provision is both compliant and fair. The correct approach involves a thorough review of the specific policy contract and the applicable regulatory guidelines to determine eligibility for the waiver of premium benefit based on the documented disability and the policy's terms. This approach is correct because it prioritizes adherence to the contractual agreement and regulatory mandates. Specifically, it ensures that the insurer acts in accordance with the established rules for waiving premiums, preventing arbitrary denial or approval of the benefit. This aligns with the ethical duty to uphold contractual promises and regulatory requirements, ensuring consumer protection and fair treatment. An incorrect approach that involves immediately denying the waiver of premium solely because the insured has returned to part-time work, without a comprehensive assessment of their ability to perform substantial and material duties as defined by the policy and regulations, is professionally unacceptable. This fails to consider the policy's definition of disability and the specific conditions under which the waiver is triggered. It also risks violating regulatory provisions that protect insured individuals during periods of disability, potentially leading to unfair claim denial. Another incorrect approach, which is to automatically approve the waiver of premium without verifying the insured's continued disability status and compliance with policy notification requirements, is also professionally unacceptable. This can lead to financial strain on the insurer if the waiver is granted inappropriately, and may also create a false sense of security for the insured if their eligibility is not regularly reassessed as per policy terms. It bypasses essential due diligence and risk management processes. A third incorrect approach, which is to interpret the waiver of premium provision in a manner that is overly restrictive and not aligned with the spirit of the benefit, as intended to provide financial relief during disability, is professionally unsound. This can lead to a breach of implied good faith and fair dealing, as well as potential violations of consumer protection regulations that aim to ensure benefits are accessible when legitimately due. The professional decision-making process for similar situations should involve a systematic review of the policy contract, including definitions of disability and the specific conditions for the waiver of premium. This should be followed by a thorough investigation of the insured circumstances, gathering all necessary documentation to assess eligibility against both the policy terms and the relevant regulatory framework. If there is any ambiguity, seeking clarification from legal or compliance departments is crucial. The ultimate decision must be well documented, transparent, and justifiable based on the evidence and applicable rules. Question 3. Cost-benefit analysis shows that a new data analytics platform offers significant operational efficiencies and cost savings for the firm. However, the platform will process a large volume of sensitive customer financial data. What is the most appropriate approach to ensure compliance with privacy regulations during the implementation of this platform? Option A. Prioritize the cost savings and operational efficiencies, assuming the IT department's standard security measures are sufficient for privacy compliance. Option B. Conduct a comprehensive data privacy impact assessment (DPIA) before full platform implementation to identify and mitigate potential privacy risks. Option C. Implement the platform immediately to realize the cost savings, and then conduct a review of privacy controls after the system is operational. Option D. Assign the entire responsibility for privacy compliance related to the platform to the IT department, without broader consultation. The correct answer is B. Conduct a comprehensive data privacy impact assessment, DPIA, before full platform implementation to identify and mitigate potential privacy risks. Explanation: scenario analysis. This scenario presents a common implementation challenge for financial services firms dealing with sensitive customer data. The challenge lies in balancing the operational efficiency gains from a new data analytics platform with the stringent privacy obligations mandated by relevant regulations. Specifically, the firm must ensure that the implementation of this platform does not inadvertently lead to unauthorized access, disclosure, or misuse of customer information, which could result in significant regulatory penalties, reputational damage, and loss of customer trust. The need to integrate new technology while maintaining robust data protection requires careful planning, risk assessment, and ongoing vigilance. Correct approach analysis. The correct approach involves a proactive and comprehensive data privacy impact assessment, DPIA, conducted before the platform's full implementation. This assessment would systematically identify potential privacy risks associated with the platform's data processing activities, evaluate the likelihood and impact of these risks, and determine appropriate mitigation measures. Regulatory frameworks, such as those governing data protection in financial services, often mandate or strongly recommend such assessments to ensure compliance with principles like data minimization, purpose limitation, and security. By embedding privacy considerations into the design and implementation phases, the firm can build privacy by design and privacy by default into the new system, thereby minimizing the likelihood of breaches and ensuring adherence to legal and ethical standards. This approach demonstrates a commitment to responsible data stewardship and regulatory compliance. Incorrect approaches analysis. Implementing the platform first and then conducting a post-implementation review of privacy controls is an inadequate approach. This reactive strategy risks discovering privacy violations only after they have occurred, potentially leading to data breaches, regulatory fines, and reputational harm. It fails to adhere to the principle of proactive risk management and privacy by design, which are central to many data protection regulations. Focusing solely on the cost savings and operational efficiencies without a dedicated privacy review overlooks the fundamental legal and ethical obligations to protect customer data. This approach prioritizes business objectives over regulatory compliance and customer privacy, creating a significant risk of non-compliance and potential legal repercussions. Delegating the entire privacy compliance responsibility to the IT department, without involving legal, compliance, and business stakeholders, is also a flawed strategy. While IT plays a crucial role in technical security, privacy compliance is a multifaceted issue that requires expertise from various departments to ensure all legal, ethical, and business implications are considered. This siloed approach can lead to gaps in understanding and implementation of privacy requirements. Professional reasoning. Professionals in the financial services industry must adopt a risk-based and compliance-driven approach to technology implementation. This involves integrating privacy considerations from the outset of any project. A robust decision-making process should include 1. Early identification of data processing activities and associated privacy risks. 2. Conducting thorough privacy impact assessments involving all relevant stakeholders. 3. Implementing appropriate technical and organizational measures to mitigate identified risks. 4. Establishing ongoing monitoring and review mechanisms to ensure continued compliance. 5. Prioritizing regulatory adherence and ethical data handling alongside business objectives. Question 4. The risk matrix shows a significant increase in the frequency and severity of long-term disability claims over the past 2 years, coupled with a projected rise in interest rates. An actuary is tasked with setting reserves for a block of disability income policies. Which of the following approaches best aligns with regulatory requirements for claims reserving in the U.S.? Option A. Solely relying on the average claim duration and cost from the previous 5 years to project future claim payments. Option B. employing a combination of actuarial methods, including Ibner and case reserve analysis, and adjusting for anticipated trends and policy provisions, with a focus on a prudent estimate of future liabilities. Option C. Utilizing a single, simplified actuarial method without performing sensitivity analysis or considering alternative methodologies. Option D. Setting reserves at a level significantly higher than indicated by actuarial analysis to create a larger buffer for unexpected events. Correct answer is B. Employing a combination of actuarial methods, including Ibner and case reserve analysis, and adjusting for anticipated trends and policy provisions, with a focus on a prudent estimate of future liabilities. Explanation. The scenario presents a professional challenge because actuaries responsible for claims reserving must balance the need for accurate financial reporting with the inherent uncertainty in estimating future claim payments. This is particularly true for disability income claims, which can have long durations and are subject to evolving medical understanding and economic factors. The challenge lies in selecting an appropriate reserving methodology that reflects the best available data and actuarial judgment, while adhering to regulatory requirements for prudence and solvency. The correct approach involves utilizing a combination of methods, including but not limited to the incurred but not reported Ibner method and the case reserve method, adjusted for anticipated trends and policy provisions. This approach is justified by regulatory frameworks that mandate reserves to be sufficient to cover all liabilities. Specifically, in the U.S. context governed by state insurance departments and NAIC guidelines, reserves must be calculated using sound actuarial principles and reflect a prudent estimate of future obligations. This often means employing multiple methods and selecting a reserve that is neither overly optimistic nor pessimistic, aligning with the principle of conservatism in financial reporting. An incorrect approach would be to solely rely on historical averages without considering current claim development trends or policyholder behavior. This fails to account for potential shifts in claim duration or severity, leading to potentially inadequate reserves and violating the regulatory requirement for reserves to be sufficient. Another incorrect approach is to use a single, simplistic method without cross-validation or sensitivity analysis. This lacks the robustness required by actuarial standards of practice and regulatory oversight, which expect actuaries to explore a range of outcomes and justify their chosen reserve. A third incorrect approach would be to intentionally set reserves at an overly conservative level to bolster surplus, without a sound actuarial basis for such conservatism. This can distort financial statements and may be viewed as an attempt to manipulate financial results, which is ethically and regulatorily unacceptable. Professional decision-making in such situations requires a systematic process. First, thoroughly understanding the data and the underlying assumptions. Second, selecting and applying appropriate actuarial methods, often a blend of techniques. Third, performing sensitivity analyses and scenario testing to understand the range of potential outcomes. Fourth, documenting the methodology, assumptions, and rationale for the chosen reserve. And finally, ensuring compliance with all applicable regulatory requirements and professional standards of practice. Question 5. Cost-benefit analysis shows that a new disability income product could achieve a higher profit margin if its benefit triggers are set at a very high threshold, making claims less likely for the average policyholder, and if premium rates are based on a slightly optimistic projection of future claims experience. The product is intended for a demographic with moderate income levels. Which of the following approaches to product design and pricing best aligns with regulatory expectations for consumer protection and market integrity? Option A. Design the product with benefit triggers that are clearly defined and reasonably accessible to the target demographic, and price it based on conservative actuarial assumptions that ensure long-term solvency and affordability, while also conducting thorough market research to confirm consumer needs and understanding. Option B. Implement the higher benefit trigger thresholds and optimistic premium projections identified in the cost-benefit analysis to maximize immediate profitability and gain a competitive edge through lower initial pricing. Option C. Prioritize rapid product launch by using simplified actuarial models and standard industry benefit triggers without extensive market research to quickly capture market share. Option D. Focus on developing a product with a complex structure and numerous exclusions that, while potentially profitable, requires significant consumer education to understand. thereby shifting the burden of comprehension onto the policyholder. The correct answer is A. Design the product with benefit triggers that are clearly defined and reasonably accessible to the target demographic, and price it based on conservative actuarial assumptions that ensure long-term solvency and affordability, while also conducting thorough market research to confirm consumer needs and understanding. Explanation: this scenario is professionally challenging because it requires balancing the financial viability of a new disability income product with the ethical imperative to ensure fair and transparent product design that meets the needs of the target market without exploiting potential vulnerabilities. The regulators focus on ensuring products are not designed to be inherently unprofitable or to mislead consumers, necessitates a rigorous approach to product development that goes beyond mere cost-benefit calculations. The correct approach involves a comprehensive product design process that prioritizes consumer needs and regulatory compliance. This includes thorough market research to understand the target demographic's actual disability risks and income replacement needs, followed by the development of policy terms and conditions that are clear, unambiguous, and aligned with these needs. Pricing must be actuarially sound, reflecting the true risk and ensuring long-term solvency, while also remaining competitive and affordable for the intended consumer base. Crucially, this approach necessitates robust internal controls and ongoing monitoring to ensure the product remains suitable and is marketed ethically. Regulatory justification stems from principles of consumer protection, fair dealing, and market integrity, which are fundamental to insurance regulation. An incorrect approach that focuses solely on maximizing profit through aggressive underwriting, or by designing features that are unlikely to be claimed by the average policyholder, fails to meet regulatory expectations. Such an approach could be seen as predatory, exploiting information asymmetry, and potentially leading to products that are missold or do not provide genuine value to consumers. This would violate principles of fair treatment of customers and could lead to regulatory sanctions for misrepresentation or unfair market practices. Another incorrect approach that prioritizes speed to market over thoroughness, leading to a product with poorly defined benefits or ambiguous exclusions, also presents significant regulatory and ethical risks. This can result in consumer disputes, claims denials that are perceived as unfair, and damage to the insurer's reputation. Regulators expect products to be designed with clarity and to deliver on their promises, and a lack of diligence in this area would be a clear failure. The professional decision-making process for similar situations should involve a multidisciplinary team including actuaries, product development specialists, legal counsel, and compliance officers. This team should rigorously assess market demand, risk profiles, pricing adequacy, and the clarity of policy terms. A strong emphasis should be placed on understanding the consumer's perspective and ensuring that the product design and pricing are not only financially sound, but also ethically defensible and compliant with all applicable regulations. The process should include a formal review and approval stage that explicitly considers consumer outcomes and regulatory adherence. Question 6. What factors determine the eligibility of a lapsed disability income policy for reinstatement under the regulatory framework governing such policies? Option A. The length of time since the policy lapsed and the policyholder's age at the time of lapse. Option B. The severity of the policyholder's current disability and the insurer's desire to retain the policyholder as a client. Option C. The policyholder's health status at the time of application for reinstatement, payment of overdue premiums, and adherence to any specific conditions outlined in the policy's reinstatement provision. Option D. The policyholder's employment status at the time of lapse and the insurer's current financial health. The correct answer is C. The policyholder's health status at the time of application for reinstatement, payment of overdue premiums, and adherence to any specific conditions outlined in the policy's reinstatement provision. Explanation: this scenario is professionally challenging because it requires the insurance professional to navigate the delicate balance between upholding the insurer's contractual rights and obligations, and demonstrating fairness and understanding towards a policyholder facing a health crisis. The core of the challenge lies in accurately applying the reinstatement provisions of the policy and relevant regulations, which often involve subjective elements like good health and insurable risk, while also maintaining a positive client relationship. Careful judgment is required to ensure that the decision is not only compliant but also ethically sound. The correct approach involves a thorough review of the policy's specific reinstatement clause, the applicable state insurance regulations regarding reinstatement, and the policyholder's medical history and current health status. This approach is right because it directly addresses the regulatory framework governing disability income insurance reinstatements. Specifically, state insurance laws typically outline the conditions under which a lapsed policy can be reinstated, often requiring the insured to be in good health at the time of application for reinstatement and to pay any overdue premiums. The insurer must assess whether the policyholder meets these criteria based on the information provided and potentially a medical examination, adhering strictly to the policy contract and regulatory mandates. This ensures that the insurer is not assuming undue risk and that the policyholder is being treated fairly within the established legal and contractual boundaries. An incorrect approach would be to automatically deny reinstatement solely because the policyholder is currently experiencing a disability, without a proper assessment of their health status at the time of the reinstatement application and the specific terms of the policy's reinstatement provision. This fails to acknowledge that a policyholder may have become disabled after the policy lapsed, and the reinstatement clause may still permit reinstatement if they were in good health at the time of application for reinstatement and paid the required back premiums. Another incorrect approach would be to approve reinstatement without verifying the policyholder's health status at the time of application, potentially exposing the insurer to significant risk that was not contemplated at the time of policy issuance or that is contrary to the policy's reinstatement terms. This bypasses the insurer's right to assess risk and could lead to adverse selection. A third incorrect approach would be to impose reinstatement requirements that are not stipulated in the policy or mandated by regulation, such as requiring a waiting period for benefits to become payable that is longer than what the policy allows, or demanding additional underwriting information beyond what is reasonably necessary to assess insurability under the reinstatement clause. This could be seen as an unfair trade practice. Professionals should employ a decision-making framework that prioritizes a systematic review of the policy contract, relevant statutes and regulations, and all submitted documentation. This involves understanding the specific conditions for reinstatement, the insurer's underwriting guidelines for reinstatement, and the policyholder's circumstances. When in doubt, consulting with legal counsel or senior underwriting staff is advisable to ensure compliance and mitigate risk. The process should be transparent and communicated clearly to the policyholder. Question 7. Examination of the data shows a client purchasing a disability income policy is expressing concern about their ability to pay premiums if they become disabled. They have specifically asked about adding a waiver of premium rider to their policy, stating they want to ensure they don't have to worry about premium payments if they can no longer work. Option A. Explain the waiver of premium rider in detail, including its cost, the waiting period before it becomes effective, and the conditions for its activation, and then assess its suitability based on the client's overall financial situation and risk tolerance before recommending its inclusion. Option B. Immediately add the waiver of premium rider to the policy to address the client's stated concern, assuring them that this will eliminate their premium payment obligation if they become disabled. Option C. Advise the client that the waiver of premium rider is an unnecessary expense and that they should focus on ensuring they have adequate disability coverage, as premium payments are a standard part of any insurance policy. Option D. Inform the client that the waiver of premium rider is only available for life insurance policies and cannot be added to a disability income policy. Correct answer is A. Explain the waiver of premium rider in detail, including its cost, the waiting period before it becomes effective, and the conditions for its activation, and then assess its suitability based on the client's overall financial situation and risk tolerance before recommending its inclusion. Explanation. This scenario presents a professional challenge because it requires balancing the client's stated desire for immediate financial relief with the fiduciary duty to ensure the client understands the long-term implications of policy choices, particularly concerning disability income insurance riders. The agent must navigate potential conflicts of interest and ensure informed consent, adhering strictly to regulatory requirements for disclosure and suitability. The correct approach involves thoroughly explaining the benefits and drawbacks of the waiver of premium rider, emphasizing its cost and the conditions under which it becomes active, and then recommending it only if it aligns with the client's long-term financial security and risk tolerance, as determined through a comprehensive needs analysis. This aligns with regulatory frameworks that mandate agents act in the client's best interest, provide clear and accurate information about policy features, and ensure that recommended products are suitable for the client's circumstances. The ethical obligation is to prioritize the client's well-being over immediate sales pressure. An incorrect approach would be to immediately add the waiver of premium rider without a detailed explanation of its costs and benefits, or to downplay its significance. This fails to meet the regulatory requirement for full disclosure and can lead to a client making an uninformed decision, potentially resulting in dissatisfaction or financial strain later. Ethically, this prioritizes a quick sale over the client's understanding and long-term needs. Another incorrect approach would be to refuse to discuss the rider at all, citing its cost as the sole reason, without exploring if it might indeed be a valuable component of the client's overall disability income protection strategy. This demonstrates a lack of due diligence in understanding the client's needs and a failure to provide comprehensive advice. Professionals should employ a decision-making process that begins with a thorough needs analysis, followed by a clear and comprehensive explanation of all relevant policy features and riders, including their costs and benefits. This should be followed by a discussion of suitability, ensuring the client understands how each feature impacts their coverage and financial obligations. The final decision must be the client's, based on complete and accurate information and documented appropriately. Question 8. When evaluating an attending physician statement apps for a disability income claim, and the provided information is somewhat vague regarding the functional limitations imposed by the claimant's diagnosed condition, what is the most appropriate next step for the claims professional to ensure a fair and compliant claim adjudication? Option A. Contact the attending physician to seek specific clarification on the functional limitations and their impact on the claimant's ability to perform their occupation, referencing the policy definitions of disability. Option B. Request all available medical records from the claimant's entire medical history, regardless of relevance to the current condition, to ensure a comprehensive understanding. Option C. Deny the claim due to insufficient medical evidence to establish disability, as the APS does not clearly outline the limitations. Option D. Immediately request a second opinion from an independent medical examiner to obtain a definitive assessment of the claimant's functional capacity. The correct answer is D. Immediately request a second opinion from an independent medical examiner to obtain a definitive assessment of the claimant's functional capacity. Explanation. This scenario presents a common challenge in disability income claims, balancing the need for comprehensive information to make a fair decision with the claimant's right to privacy and the efficient use of resources. The attending physician statement (APS) is a critical document, but its interpretation and the subsequent actions taken by the claims professional require careful judgment to adhere to regulatory requirements and ethical standards. The correct approach involves a thorough review of the APS to identify any ambiguities or missing information that directly impacts the assessment of the claimant's disability. If the APS is unclear regarding the severity of the condition, its impact on the claimant's ability to perform their occupation, or the prognosis, it is appropriate to seek clarification from the attending physician. This clarification should be specific to the information needed to adjudicate the claim fairly and in accordance with policy provisions and regulatory guidelines. This approach respects the claimant's privacy by only requesting information directly relevant to the claim and ensures that the decision is based on the most accurate and complete medical evidence available, thereby fulfilling the insurer's obligation to process claims diligently and fairly. An incorrect approach would be to automatically request a second opinion from an independent medical examiner, (IME), without first attempting to clarify the existing APS. This is an inefficient use of resources and can be perceived as adversarial by the claimant, potentially delaying the claim unnecessarily. It fails to leverage the existing physician-patient relationship and the physician's direct knowledge of the claimant's condition. Another incorrect approach would be to deny the claim solely based on a perceived lack of sufficient information in the APS without making a reasonable effort to obtain the necessary clarification. This could lead to an unfair denial and potential regulatory violations for failing to conduct a thorough investigation. Finally, requesting overly broad or irrelevant medical information beyond what is necessary to assess the disability would violate the claimant's privacy rights and could be seen as an overreach by the insurer. Professionals should adopt a systematic decision-making process. First, thoroughly review all submitted medical documentation, including the APS. Identify specific areas of ambiguity or missing information that are crucial for claim adjudication. Second, determine if clarification from the attending physician can resolve these issues. If so, formulate precise, targeted questions to the physician. Third, if clarification is insufficient or if there are significant discrepancies or complexities, consider further investigation, such as requesting additional medical records or, as a last resort, an MA, always ensuring the request is focused and justified. Throughout this process, maintain clear communication with the claimant regarding the status of their claim and any information being requested. Question 9. Compliance review shows that a disability income policy was issued to an applicant who disclosed a history of back pain. The policy contains a pre-existing condition limitation clause that excludes coverage for conditions diagnosed or treated within 12 months prior to the policy's effective date. The applicant later files a claim for disability due to a herniated disc, which their physician states developed gradually over several years, with the most recent flare-up occurring 6 months before the policy's effective date. The insurer is considering denying the claim based on the pre-existing condition limitation. Which of the following approaches best aligns with regulatory requirements and ethical considerations for assessing this claim? Option A. Investigate further to determine if the herniated disc was diagnosed or treated within the 12-month look-back period as defined by the policy, and if the applicant was adequately informed of the pre-existing condition limitation at the time of application. Option B. Apply the pre-existing condition limitation only to the portion of the disability directly attributable to the flare-up 6 months before the policy's effective date, and pay benefits for the remainder of the disability. Option C. Deny the claim immediately, as the applicant had a history of back pain prior to the policy's effective date, and the herniated disc is related to that history. Option D. Approve the claim without further investigation, as the applicant's condition developed gradually, and the insurer should not penalize individuals for pre-existing conditions that are not immediately debilitating. Correct answer is C. Deny the claim immediately, as the applicant had a history of back pain prior to the policy's effective date, and the herniated disc is related to that history. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how pre-existing condition limitations are applied in practice, balancing the insurer's right to manage risk with the applicant's right to fair disclosure and coverage. The challenge lies in interpreting the policy wording and the applicant's medical history to determine if a condition was truly pre-existing, and if the limitation was properly disclosed and applied according to regulatory standards. Careful judgment is required to avoid both unfairly denying coverage and exposing the insurer to undue risk. The correct approach involves a thorough review of the policy's pre-existing condition clause, the applicant's medical records, and the timeline of diagnosis and treatment. This approach correctly identifies that a pre-existing condition limitation can only be applied if the condition was diagnosed or treated prior to the policy's effective date, and if the policy clearly outlines the terms of such a limitation. Regulatory frameworks typically require clear and conspicuous disclosure of these limitations to the applicant. Therefore, verifying that the applicant was aware of and understood the limitation, and that the condition in question meets the policy's definition of pre-existing, is paramount. This aligns with the ethical obligation to act in good faith and to ensure policy terms are applied fairly and transparently. An incorrect approach would be to automatically deny coverage based solely on the applicant's mention of a past medical issue without a detailed investigation. This fails to adhere to the regulatory requirement for clear evidence that the condition was pre-existing according to the policy's definition and that the limitation was properly disclosed. Another incorrect approach would be to assume the limitation applies without verifying the applicant's knowledge and understanding of its terms, which violates disclosure requirements and the principle of fair dealing. Furthermore, misinterpreting the policy wording or the medical evidence to broadly apply the limitation beyond its intended scope would be a regulatory failure, potentially leading to a breach of contract and unfair claims handling. Professionals should employ a decision-making framework that prioritizes a comprehensive review of all relevant documentation, including the policy contract, medical history, and any correspondence with the applicant. This framework should involve seeking clarification on ambiguous policy terms or medical information, and consulting with underwriting or legal counsel when necessary. The ultimate decision must be grounded in a factual assessment of whether the policy's pre-existing condition limitation was validly applied according to both the policy's terms and applicable regulations, ensuring fairness to both the applicant and the insurer. Question 10. The evaluation methodology shows that the proposed new disability income product's initial pricing structure is highly competitive, driven by assumptions regarding future morbidity rates that are significantly more optimistic than current industry benchmarks and the company's own historical experience. The product development team is eager to launch this innovative product to capture market share, but the actuary responsible for pricing has concerns about the long-term sustainability of these aggressive morbidity assumptions. What is the most ethically and regulatorily sound approach for the actuary to take in this situation? Option A. Advocate for a revised pricing structure that incorporates more conservative and well-supported morbidity assumptions, providing detailed analysis to management demonstrating the potential risks associated with the aggressive assumptions and their impact on long-term solvency and policyholder benefits. Option B. Suggest deferring the product launch until more favorable economic conditions or a significant improvement in industry morbidity data becomes available, allowing for more robust justification of the optimistic assumptions. Option C. Recommend a phased rollout of the product, starting with a limited market segment using the aggressive assumptions to gather real-world data before a broader launch, while acknowledging the inherent risks. Option D. Proceed with the proposed pricing, documenting the optimistic assumptions and noting them as a key driver of competitiveness, with the understanding that future experience will be closely monitored and adjustments made if necessary. The correct answer is D. Proceed with the proposed pricing, documenting the optimistic assumptions and noting them as a key driver of competitiveness, with the understanding that future experience will be closely monitored and adjustments made if necessary. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of innovation and market competitiveness with the fundamental ethical and regulatory obligation to ensure product sustainability and fairness to policyholders. The actuary must navigate the tension between developing a product that is attractive to the market and ensuring that the underlying actuarial assumptions are sound, transparent, and compliant with regulatory standards for solvency and consumer protection. The pressure to launch a novel product quickly can create an environment where rigorous validation of assumptions might be perceived as a bottleneck, necessitating careful ethical judgment. The correct approach involves a thorough and documented validation of all actuarial assumptions, including those related to morbidity, mortality, expenses, and investment returns, against robust data and industry best practices. This approach is ethically and regulatorily sound because it upholds the actuary's duty to provide objective and impartial advice, ensuring that the product is priced appropriately and has a reasonable prospect of fulfilling its promises to policyholders. Specifically, it aligns with the principles of professional conduct that require actuaries to act with integrity, competence, and due care, and to adhere to relevant professional standards and regulatory requirements, such as those mandated by the relevant actuarial professional bodies and insurance regulators. This ensures that the product's pricing and reserving are not based on overly optimistic or unsupported assumptions, which could jeopardize the insurer's financial stability and lead to future policyholder detriment. An incorrect approach that relies on aggressive or unsupported assumptions to achieve a desired pricing outcome is ethically and regulatorily flawed. This failure stems from a breach of the duty of care and integrity, as it prioritizes market appeal over actuarial soundness. Such an approach could violate regulations designed to protect consumers from inadequate pricing and solvency issues, potentially leading to regulatory sanctions, reputational damage, and financial losses for the insurer and its policyholders. Another incorrect approach that bypasses or inadequately documents the validation process, even if the assumptions are ultimately reasonable, is also problematic. This failure lies in the lack of transparency and auditability, which are crucial for regulatory oversight and professional accountability. It undermines the actuary's ability to demonstrate compliance and can lead to questions about the rigor of the product development process. The professional decision-making process for similar situations should involve a structured approach that prioritizes ethical considerations and regulatory compliance. This includes clearly identifying all assumptions, rigorously testing their validity using appropriate data and methodologies, documenting the entire process thoroughly, and seeking peer review or consultation when necessary. The actuary must be prepared to articulate and defend their assumptions and methodologies to management, the board, and regulators, ensuring that the product development process is transparent, robust, and aligned with the long-term interests of both the company and its policyholders. Question 11. Regulatory review indicates that underwriting for disability income insurance requires careful consideration of applicant characteristics. When evaluating an applicant's potential for disability income claims, which approach best aligns with regulatory requirements and ethical underwriting practices concerning age, gender, and lifestyle? Option A. Base all underwriting decisions solely on the applicant's stated occupation, disregarding any other lifestyle factors, age, or gender as irrelevant to disability income risk. Option B. Differentiate premiums based on statistically validated lifestyle choices that demonstrably impact morbidity, while ensuring age-related adjustments are actuarially sound, and gender is considered only if current regulations and actuarial data permit and justify such differentiation without unfair discrimination. Option C. Exclude applicants over a certain age or of a specific gender from coverage entirely, citing general actuarial trends without individual risk assessment. Option D. Apply a standardized age-based premium adjustment across all applicants within broad age bands, and assign different premium rates for male and female applicants based on historical actuarial data, irrespective of current lifestyle or health status. The correct answer is B. Differentiate premiums based on statistically validated lifestyle choices that demonstrably impact morbidity, while ensuring age-related adjustments are actuarially sound, and gender is considered only if current regulations and actuarial data permit and justify such differentiation without unfair discrimination. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the ethical and regulatory imperative to avoid unfair discrimination. The DIF exam jurisdiction's regulations strictly prohibit underwriting practices that unfairly discriminate based on protected characteristics, while simultaneously requiring sound actuarial principles for pricing and risk selection. The challenge lies in distinguishing between legitimate actuarial considerations related to risk factors, like lifestyle choices that demonstrably impact morbidity, and prohibited discrimination based on inherent characteristics, like gender, unless demonstrably linked to statistically significant and actuarially sound differences in morbidity that are not otherwise prohibited. The correct approach involves a nuanced assessment that differentiates between lifestyle factors with a direct, statistically validated, and actuarially significant impact on disability income risk, and inherent characteristics like gender that may have historical actuarial relevance, but are now subject to strict regulatory scrutiny for potential unfair discrimination. This approach aligns with the regulatory framework by focusing on demonstrable risk factors that are not inherently discriminatory. It upholds ethical principles by ensuring that underwriting decisions are based on objective data and sound actuarial principles, rather than stereotypes or prohibited biases. The regulatory justification stems from provisions that allow for differentiation based on actuarially sound principles, provided such differentiation does not constitute unfair discrimination. An incorrect approach that relies solely on broad generalizations about age or gender without specific, actuarially validated links to morbidity for the product in question would be ethically and regulatorily flawed. This would constitute unfair discrimination if it leads to disparate treatment without a sound actuarial basis. For instance, applying a blanket higher premium to all individuals of a certain age group without considering individual health status or lifestyle, or making assumptions about disability risk based solely on gender without robust, current actuarial data that justifies such a distinction and complies with regulatory prohibition, would be problematic. Such practices fail to adhere to the principle of individual risk assessment and can lead to adverse selection or market exclusion, violating regulatory mandates for fair and equitable treatment of applicants. The professional decision-making process should involve a thorough review of the applicant's disclosed information, focusing on lifestyle choices that have a direct and quantifiable impact on health and disability risk. This includes evaluating factors such as occupation, hazardous hobbies, and health habits. When considering age, the focus should be on how it relates to the natural progression of health conditions and their impact on disability, rather than simply applying a broad age-based loading. Gender should only be considered if there is clear, current, and actuarially sound evidence of a statistically significant difference in morbidity that is permissible under the specific regulatory framework. And even then, it must be applied equitably and without unfair discrimination. The underwriter must always be prepared to justify their decisions based on objective data and regulatory compliance. Question 12. The control framework reveals that an applicant for a significant disability income policy has provided tax returns showing fluctuating business income and significant personal investments. The underwriter must determine the most appropriate method for verifying the applicant's insurable income. Which of the following approaches best aligns with the principles of sound financial underwriting and regulatory compliance for disability income insurance? Option A. Requesting detailed financial statements, business records, and tax returns for the past 3 to 5 years, and cross-referencing this information with industry benchmarks and, where appropriate, third-party verification services to establish a stable and verifiable average earned income. Option B. Accepting the applicant's stated income from the most recent tax return as the sole basis for policy issuance, assuming their net worth indicates sufficient financial capacity. Option C. Focusing primarily on the applicant's total net worth as a proxy for their financial stability, and issuing the policy based on a percentage of their total assets, disregarding the specific nature of their earned income. Option D. Relying on a verbal confirmation of income from the applicant's accountant without requesting any supporting documentation, given the applicant's high net worth. The correct answer is A. Requesting detailed financial statements, business records, and tax returns for the past 3 to 5 years, and cross-referencing this information with industry benchmarks and, where appropriate, third-party verification services to establish a stable and verifiable average earned income. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate income verification with the potential for misinterpretation of an applicant's financial stability, particularly when dealing with complex income structures and significant net worth. The core challenge lies in ensuring that the disability income policy issued accurately reflects the applicant's true insurable income without being overly burdensome or intrusive, while adhering strictly to regulatory guidelines designed to prevent adverse selection and ensure policy sustainability. The correct approach involves a thorough and documented review of all provided financial documentation, cross-referencing it with reliable third-party sources where permissible and necessary, and applying underwriting guidelines consistently. This approach is correct because it directly addresses the regulatory requirement for diligent income verification. By seeking to understand the nature and stability of the applicant's income, and by considering net worth as a secondary indicator of financial capacity and potential for lifestyle maintenance during a disability, the underwriter fulfills their ethical duty to both the applicant and the insurer. This aligns with the principle of underwriting for risk accurately, ensuring that premiums reflect the actual risk assumed, and that the policy benefits are appropriately structured based on verified income. Regulatory frameworks for disability income insurance emphasize the importance of accurate income assessment to prevent overinsurance and to maintain the financial integrity of the insurance pool. An incorrect approach that relies solely on the applicant's stated income without independent verification fails to meet regulatory standards for due diligence. This could lead to the issuance of a policy with benefits that are not supported by verifiable income, increasing the insurer's risk and potentially leading to disputes during the claims process. It also violates the ethical obligation to underwrite based on objective evidence. Another incorrect approach that focuses excessively on net worth to the exclusion of income verification is also problematic. While net worth can provide context, disability income insurance is fundamentally designed to replace lost earned income. Over-reliance on net worth might lead to misjudging the applicant's reliance on active earnings, potentially resulting in an inappropriate policy structure or benefit amount. This deviates from the core purpose of disability income insurance and the regulatory intent behind income verification. A third incorrect approach that involves accepting unsubstantiated explanations for income discrepancies without seeking corroborating evidence or applying standard underwriting procedures is a direct contravention of regulatory expectations. This demonstrates a lack of professional rigor and can expose the insurer to significant risk. The professional decision-making process for similar situations should involve a systematic review of all available information, a clear understanding of the insurer's underwriting guidelines and the relevant regulatory framework, and a commitment to objective assessment. When faced with complex financial situations, underwriters should document their rationale for decisions, seek clarification from supervisors or underwriting committees when necessary, and always prioritize compliance with regulations and ethical standards. The goal is to make an informed decision that is both fair to the applicant and sound from an insurance perspective. Question 13. The risk matrix shows a high probability of adverse selection and increased claims costs associated with poorly managed return-to-work programs. Considering the regulatory framework for disability income insurance, which approach to managing a policyholder's return-to-work plan is most aligned with professional best practices and regulatory compliance? Option A. Automatically initiating a review for benefit termination once a policyholder has been disabled for a predetermined period, regardless of their current medical and vocational capacity. Option B. Requiring the policyholder to independently secure and present evidence of their inability to return to work before any further benefits are considered. Option C. Implementing a proactive, individualized return-to-work plan developed collaboratively with the policyholder and their medical providers, focusing on gradual reintegration and ongoing support. Option D. Utilizing a standardized, generic return-to-work template for all policyholders, assuming a uniform recovery trajectory and work capacity. The correct answer is C. Implementing a proactive, individualized return-to-work plan developed collaboratively with the policyholder and their medical providers, focusing on gradual reintegration and ongoing support. Explanation: this scenario is professionally challenging because it requires balancing the insurer's financial interests with the policyholder's right to benefits and the ethical imperative to support recovery. The insurer must navigate the complexities of a return-to-work program, ensuring it is implemented fairly and effectively without prematurely terminating benefits or creating undue hardship for the claimant. The risk matrix highlights potential issues such as adverse selection, increased claims costs due to ineffective programs, and reputational damage if programs are perceived as punitive. Careful judgment is required to design and manage programs that genuinely assist policyholders in returning to work, while adhering to regulatory requirements and ethical standards. The correct approach involves a comprehensive assessment of the policyholder's capacity for return to work, considering medical, vocational, and psychological factors. This approach prioritizes a collaborative effort between the insurer, the policyholder, and relevant medical professionals to develop a personalized and realistic return-to-work plan. This aligns with the regulatory framework's emphasis on fair claims handling and the ethical obligation to act in the best interests of the policyholder, promoting their well-being and rehabilitation. Such a structured and individualized process ensures that decisions regarding benefits are based on objective assessments of the policyholder's ability to perform work, rather than solely on the duration of their absence. An incorrect approach that focuses solely on the duration of the disability and automatically triggers a review for benefit termination without a thorough assessment of the policyholder's current capacity fails to meet regulatory standards for fair claims handling. This approach disregards the individual circumstances of the claimant and may lead to the premature cessation of benefits, potentially causing financial distress and hindering recovery. Ethically, it breaches the duty of care owed to the policyholder. Another incorrect approach that relies on a standardized, one-size-fits-all return-to-work program without considering individual needs and limitations is also professionally unacceptable. This rigid methodology can be ineffective and may even be detrimental to a policyholder's recovery, as it fails to account for the unique challenges each individual faces. It also risks violating regulations that mandate individualized claims assessments. A third incorrect approach that places the onus entirely on the policyholder to prove their inability to return to work without proactive support or guidance from the insurer is ethically and regulatorily flawed. This shifts the burden unfairly and can be seen as an adversarial stance, contrary to the principles of good faith and cooperation expected in insurance relationships. The professional decision-making process for similar situations should involve a systematic evaluation of the policyholder's condition, a thorough understanding of the policy's terms and conditions, and strict adherence to all applicable regulations. It requires open communication, empathy, and a commitment to finding solutions that support the policyholder's recovery and return to work where feasible, while also managing the insurer's risk responsibly. Question 14. The risk matrix shows a potential for client misunderstanding regarding the duration of disability benefits. A client is inquiring about the difference between short-term and long-term disability benefit periods, expressing a personal view that short-term could mean up to a year. Which approach best aligns with regulatory compliance for a DIF professional operating under the specified regulatory framework? Option A. Define short-term disability based on the client's subjective understanding of short, and then explain long-term disability as simply a continuation of benefits beyond that personal definition. Option B. State that the distinction between short-term and long-term disability benefit periods is largely a matter of policy wording and client negotiation, with regulatory definitions being secondary to individual contract terms. Option C. Agree with the client's perception that short-term disability could extend to a year, as individual circumstances can vary significantly, and then explain that long-term disability would follow this extended period. Option D. Explain that short-term disability benefits typically have a defined maximum duration, often up to 6 months, as stipulated by regulatory guidelines, while long-term disability benefits commence thereafter and continue for a longer, defined period, also governed by regulations. The correct answer is D. Explain that short-term disability benefits typically have a defined maximum duration, often up to 6 months, as stipulated by regulatory guidelines, while long-term disability benefits commence thereafter and continue for a longer, defined period, also governed by regulations. Explanation. This scenario is professionally challenging because it requires the DIF professional to navigate the nuances of benefit period definitions within the context of a specific regulatory framework, ensuring compliance while advising a client. The client's understanding of short-term versus long-term disability benefits can be subjective and may not align with the precise legal definitions, necessitating clear and accurate communication grounded in regulatory requirements. The correct approach involves accurately distinguishing between short-term and long-term disability benefit periods as defined by the relevant regulatory framework. This approach is right because it directly adheres to the legal and regulatory standards governing disability income insurance products. Specifically, it ensures that the client receives information that is factually correct according to the governing laws and guidelines, preventing misrepresentation and potential regulatory breaches. By aligning advice with these definitions, the DIF professional upholds their duty of care and ethical obligation to provide accurate information. An incorrect approach that mischaracterizes the duration of short-term disability benefits as potentially extending beyond typical statutory limits fails because it violates the principle of regulatory compliance. This misrepresentation could lead the client to have unrealistic expectations about coverage, potentially impacting their financial planning and their understanding of the policy's limitations. Such an action could be construed as misleading or deceptive conduct, which is a direct contravention of regulatory expectations for licensed professionals. Another incorrect approach that conflates the definition of long-term disability with the client's personal perception of a long time is also professionally unacceptable. This approach disregards the objective, legally defined parameters of long-term disability benefits. Relying on subjective interpretation rather than regulatory definitions can lead to significant misunderstandings about when benefits cease or change, potentially exposing the client to financial hardship and the DIF professional to disciplinary action for failing to provide accurate, regulation-based advice. The professional reasoning process for similar situations should involve a systematic review of the client's inquiry against the specific regulatory definitions and guidelines applicable to disability income insurance. Professionals must prioritize accuracy and compliance, using regulatory documents as the primary source of truth. When client perceptions diverge from regulatory realities, the professional's role is to educate the client clearly and precisely, explaining the regulatory basis for the benefit period definitions and their implications for the client's coverage. This ensures informed decision-making and maintains the integrity of the professional-client relationship within the bounds of the law. Question 15. Research into a client's disability income insurance policy reveals the presence of a cost of living adjustment, COLA rider. The client expresses concern about the higher premium associated with this rider and questions its necessity, stating they are focused on minimizing current expenses. Which of the following approaches best addresses the client's concerns while adhering to regulatory and ethical obligations? Option A. Inform the client that COLA riders are generally not cost-effective and recommend its removal without further discussion of its potential benefits. Option B. Explain the purpose of the COLA rider in maintaining the purchasing power of future disability benefits and assess the client's long-term financial goals and risk tolerance to determine if the rider is suitable. Option C. Strongly encourage the client to keep the COLA rider, emphasizing that inflation is inevitable and the benefit increase is essential, regardless of their current financial concerns. Option D. Advise the client to immediately drop the COLA rider to reduce their current premium, as minimizing immediate expenses is their stated priority. Correct answer is B. Explain the purpose of the COLA rider in maintaining the purchasing power of future disability benefits and assess the client's long-term financial goals and risk tolerance to determine if the rider is suitable. Explanation. This scenario is professionally challenging because it requires an advisor to balance the client's immediate financial concerns with the long-term implications of a policy feature designed to protect against inflation. The advisor must assess the client's risk tolerance and understanding of the COLA rider's purpose without oversimplifying or misrepresenting its value. Careful judgment is required to ensure the client makes an informed decision that aligns with their financial goals and understanding of potential future economic conditions. The correct approach involves thoroughly explaining the purpose of the cost of living adjustment, COLA, rider, emphasizing its role in preserving the purchasing power of disability income benefits over time. This includes detailing how the rider functions, the potential for benefit increases, and the associated premium cost. The advisor should then assess the client's understanding and financial capacity to sustain the higher premiums, guiding them to a decision based on their individual circumstances and risk tolerance. This aligns with regulatory requirements to provide suitable advice and act in the client's best interest, ensuring full disclosure of policy features and their implications. An incorrect approach would be to dismiss the COLA rider solely based on its immediate impact on the premium, without adequately explaining its long-term value proposition. This fails to uphold the duty of care and may lead the client to forego a valuable benefit that could significantly enhance their financial security in the future. Another incorrect approach would be to strongly advocate for the rider without a thorough assessment of the client's financial situation and risk tolerance, potentially leading to an unsuitable recommendation. This violates the principle of suitability and could result in the client being overburdened by premiums they cannot comfortably afford. Professionals should employ a decision-making framework that prioritizes client education and suitability. This involves actively listening to the client's concerns, providing clear and comprehensive explanations of policy features, assessing their financial capacity and risk appetite, and then collaboratively arriving at a decision that best serves their long-term interests. This process ensures transparency and adherence to regulatory obligations. Question 16. To address the challenge of advising a client on disability income insurance, an agent discovers the client resides in a state different from the agent's primary licensing state. The agent must ensure their recommendations and the proposed policy are fully compliant with all applicable state insurance laws and regulations. Which of the following represents the most appropriate and legally sound approach? Option A. Focus on presenting the most competitive policy features and benefits, deferring detailed state-specific compliance checks until after the policy is sold. Option B. Research and adhere strictly to the specific disability income insurance laws and regulations of the client's state of residence, including any state-mandated provisions, disclosure requirement, and consumer protection statutes. Option C. Recommend a disability income policy that has been approved in the agent's primary licensing state, assuming it will be acceptable in the client's state. Option D. Proceed with advising the client based on the agent's general knowledge of disability income insurance and the regulations of the agent's primary licensing state, assuming significant overlap. The correct answer is B. Research and adhere strictly to the specific disability income insurance laws and regulations of the client's state of residence, including any state-mandated provisions, disclosure requirements, and consumer protection statutes. Explanation: this scenario presents a professional challenge because an insurance agent must navigate the complexities of state-specific insurance laws and regulations when advising a client on disability income insurance. Misinterpreting or failing to adhere to these laws can lead to significant legal and ethical repercussions, including regulatory sanctions, financial penalties, and damage to professional reputation. The agent's primary responsibility is to ensure the client receives accurate and compliant advice tailored to their specific state of residence. The correct approach involves the agent thoroughly researching and understanding the specific state insurance laws and regulations applicable to disability income insurance in the client's state of residence. This includes understanding any mandated coverage provisions, disclosure requirements, policy limitations, and consumer protection statutes. By doing so, the agent ensures that the advice provided is legally sound, ethically responsible, and in the best interest of the client, thereby fulfilling their fiduciary duty and adhering to regulatory mandates. An incorrect approach would be to rely on general industry knowledge or the regulations of a different state. This fails to acknowledge the fundamental principle that insurance laws are state-specific. Such an approach risks providing advice that is non-compliant with the client's state laws, potentially leading to the sale of an inappropriate or illegal policy. This constitutes a breach of professional duty and regulatory noncompliance. Another incorrect approach is to assume that a policy approved in one state is automatically compliant in another. Each state has its own approval process and specific requirements for policy forms and marketing materials. Failing to verify state-specific approvals and regulations can result in offering products that are not permitted or are presented in a non-compliant manner in the client's jurisdiction. This demonstrates a lack of due diligence and a disregard for state regulatory authority. A further incorrect approach is to prioritize the sale of a particular product over ensuring compliance with state laws. While sales goals are part of an agent's role, they must always be secondary to legal and ethical obligations. Advising a client on a disability income policy without first confirming its compliance with their state's specific insurance laws is a direct violation of regulatory requirements and ethical standards, potentially exposing both the agent and the client to adverse consequences. The professional decision-making process for similar situations should involve a systematic approach. 1. Identify the client's state of residence. 2. Access and review the specific state insurance laws and regulations pertaining to disability income insurance for that state. 3. Consult relevant state insurance department resources or legal counsel if ambiguity exists. 4. Ensure all advice, product recommendations, and disclosures are fully compliant with the identified state regulations. 5. Document all research and compliance verification steps. Question 17. Analysis of how an underwriter should approach the classification of risk for a client who is a freelance deep-sea welder, considering the inherent dangers of the profession. The underwriter has access to general industry data on welding accidents and a recent report detailing advancements in safety equipment for underwater welding. Option A. Decline coverage outright due to the perceived high risk of deep-sea welding, without exploring any risk mitigation factors or alternative underwriting approaches. Option B. Conduct a detailed assessment of the specific risks associated with freelance deep-sea welding, factoring in the applicant's experience, the types of projects undertaken, and the impact of recent safety equipment advancements on the overall risk profile. Option C. Assign a standard occupational hazard rating based on the perceived danger of deep-sea work, without consulting any specific data related to welding or safety equipment. Option D. Classify the occupation based on general industry data for welding accidents, applying a standard rating for hazardous occupations without further investigation into specific safety advancements. The correct answer is D. Classify the occupation based on general industry data for welding accidents, applying a standard rating for hazardous occupations without further investigation into specific safety advancements. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the insurer's need to accurately assess risk with the ethical obligation to treat applicants fairly and avoid discriminatory practices. The underwriter must navigate the complexities of occupational hazards, recognizing that certain professions inherently carry higher risks of disability, without resorting to broad generalizations or biases. The DIF exam emphasizes adherence to regulatory frameworks that govern fair underwriting practices and risk classification. The correct approach involves a detailed, individualized assessment of the applicant's specific occupation and its associated risks, supported by objective data and industry standards. This aligns with regulatory requirements that mandate underwriting decisions be based on sound actuarial principles and a thorough understanding of the occupation's actual hazards, rather than assumptions or stereotypes. The ethical imperative is to ensure that premiums accurately reflect the risk presented by the individual's circumstances, not to penalize individuals based on their chosen profession without substantiation. An incorrect approach that relies solely on broad occupational categories without further investigation fails to meet the regulatory standard for risk assessment. It risks overclassifying individuals and charging them higher premiums than justified by their actual risk profile, potentially leading to unfair discrimination. Another incorrect approach that ignores documented safety improvements or technological advancements within a profession overlooks the dynamic nature of occupational hazards and can lead to outdated and inaccurate risk assessments. This also violates the principle of underwriting based on current, relevant data. A third incorrect approach that prioritizes speed and efficiency over thoroughness by making assumptions about risk without due diligence directly contravenes the regulatory mandate for careful and accurate risk classification. Professional decision-making in such situations requires a systematic process. First, gathering comprehensive information about the applicant's occupation, including specific duties, work environment, and any relevant safety protocols. Second, consulting reliable sources for occupational hazard data, such as industry reports, government statistics, and professional association guidelines. Third, applying underwriting guidelines that are based on objective risk factors and are consistently applied. Finally, documenting the rationale for the underwriting decision clearly and comprehensively, ensuring transparency and auditability. This process ensures compliance with regulatory requirements and upholds ethical underwriting standards. Question 18. The investigation demonstrates that a long-standing client, who has always been diligent with their disability income insurance premiums, has recently expressed a strong desire to cancel their policy. During a review meeting, the client states, "I just don't see the point anymore. I'm healthy, and I don't think I'll ever need it. I want to cancel it today." The advisor notes that the client's financial situation has recently stabilized, and they have accumulated a significant emergency fund. Which of the following approaches best manages this client relationship and adheres to professional best practices and regulatory expectations for disability income insurance advice? Option A. Inform the client that canceling the policy would be a significant mistake given their age and the potential for future health issues, and strongly advise them against it, emphasizing the financial loss they would incur. Option B. Acknowledge the client's feelings and concerns, then proactively explain the purpose of disability income insurance, the potential risks of cancellation given their current circumstances and the policy's features, and explore alternative solutions to address their concerns before proceeding. Option C. Immediately process the cancellation request as per the client's explicit instruction, assuring them that their decision is respected. Option D. Suggest that the client consider a partial surrender of the policy to reduce the premium, without fully exploring the implications of losing comprehensive coverage. The correct answer is C. Immediately process the cancellation request as per the client's explicit instruction, assuring them that their decision is respected. Explanation. This scenario is professionally challenging because it requires balancing a client's immediate, albeit potentially misinformed, desires with the advisor's fiduciary duty and regulatory obligations to ensure the client understands the implications of their decisions. The advisor must navigate the client's emotional state and potential lack of understanding without being dismissive or manipulative. The core challenge lies in providing clear, unbiased information and guidance that empowers the client to make an informed choice, even if that choice differs from their initial inclination. The correct approach involves actively listening to the client's concerns, acknowledging their feelings, and then systematically addressing their misconceptions with clear, factual information relevant to their disability income policy. This approach prioritizes client education and informed consent, which are cornerstones of ethical financial advice and regulatory compliance. Specifically, it aligns with the principles of client-centric advice, requiring advisors to act in the client's best interest, provide suitable recommendations, and ensure full disclosure of policy terms and conditions. This proactive and educational stance upholds the advisor's duty of care and promotes long-term client trust. An incorrect approach that focuses solely on the client's stated desire to cancel without further investigation fails to meet the advisor's duty to ensure suitability and understanding. This could lead to the client making a decision that is detrimental to their financial well-being, potentially breaching regulatory requirements related to advice and disclosure. Another incorrect approach, which involves pressuring the client to retain the policy without fully addressing their concerns, is equally problematic. This can be perceived as coercive and may violate ethical guidelines that prohibit undue influence and mandate client autonomy in decision-making. Finally, an approach that dismisses the client's concerns as unfounded without proper exploration risks alienating the client and failing to identify underlying issues that might be contributing to their desire to cancel, thereby neglecting the relationship management aspect of the advisor's role. Professionals should employ a decision-making framework that begins with active listening and empathy to understand the client's perspective. This should be followed by a thorough assessment of the client's needs, objectives, and understanding of their current policy. The advisor must then provide clear, objective information, explaining the benefits and drawbacks of all available options, including the implications of canceling the policy. This process ensures that the client is empowered to make an informed decision that aligns with their best interests, thereby fulfilling both ethical and regulatory obligations. Question 19. During the evaluation of a disability income insurance application, an underwriter is reviewing the applicant's medical history. The applicant has disclosed a history of asthma. Which of the following represents the most appropriate and compliant approach for the underwriter to proceed with assessing this medical condition? Option A. Decline the application immediately based on the disclosure of asthma, assuming it represents an uninsurable risk. Option B. Request a full medical history from the applicant's primary care physician, covering all conditions treated over the past 10 years, regardless of relevance to asthma. Option C. Request a detailed physician statement from the applicant's treating pulmonologist, including information on the severity, frequency, and management of the asthma, as well as any related respiratory complications or limitations. Option D. Rely solely on the applicant's self-reported description of their asthma and its impact on their daily activities without seeking further medical documentation. The correct answer is C. Request a detailed physician statement from the applicant's treating pulmonologist, including information on the severity, frequency, and management of the asthma, as well as any related respiratory complications or limitations. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for accurate risk assessment with the applicant's right to privacy and the ethical obligation to treat all applicants fairly. The underwriter must gather sufficient medical information to make a sound underwriting decision without being overly intrusive or discriminatory. The DIF exam emphasizes adherence to regulatory frameworks that govern the collection and use of medical information in insurance underwriting. The correct approach involves a systematic and compliant process for obtaining and reviewing medical history. This includes clearly informing the applicant about the purpose of the medical information collection, obtaining their explicit consent, and ensuring that the information requested is directly relevant to the underwriting of the disability income policy. Regulatory guidelines, such as those pertaining to the Health Insurance Portability and Accountability Act, HIPAA, in the U.S., mandate that protected health information, FI, is used and disclosed only for specific purposes with the individual's authorization, and that underwriting decisions are based on objective risk factors. This approach ensures compliance with privacy laws and promotes fairness by focusing on the applicant's actual health status and its impact on insurability. An incorrect approach would be to request a comprehensive medical history without a clear justification for each piece of information, potentially violating privacy regulations and exceeding the scope of necessary underwriting information. This could lead to accusations of discrimination or an invasion of privacy. Another incorrect approach would be to rely solely on the applicant's self-reported medical history without seeking independent verification through medical records or physician statements when specific conditions are disclosed that warrant further investigation. This could result in adverse selection and misrepresentation, undermining the principle of accurate risk assessment. Furthermore, making assumptions about an applicant's health status based on demographic factors rather than objective medical evidence is a clear ethical and regulatory failure, as it can lead to discriminatory practices. Professionals should employ a decision-making framework that prioritizes regulatory compliance, ethical conduct, and sound underwriting principles. This involves understanding the specific requirements of the DIF exam's jurisdiction, including relevant privacy laws and insurance regulations. When evaluating an applicant's medical history, underwriters should 1. Clearly communicate the information needs and obtain informed consent. 2. Request only information directly relevant to the underwriting of the specific policy. 3. Utilize appropriate methods for verifying disclosed medical conditions, such as requesting physician statements or medical records when necessary. 4. Ensure that all underwriting decisions are based on objective medical evidence and do not involve discriminatory practices. 5. Maintain confidentiality of all applicant information. Question 20. The performance metrics show a recurring issue with the accurate adjudication of claims involving multiple disability income policies for the same insured. A recent case involves an insured with 3 separate disability income policies from different insurers, all covering the same period of disability. The insured has provided documentation for all policies. Your task is to determine the correct process for coordinating benefits to ensure the insured is appropriately compensated without overinsuring, strictly adhering to the regulatory framework governing disability income insurance in this jurisdiction. Option A. Calculate the total potential benefit from all 3 policies and pay the insured that sum, as they have multiple coverages. Option B. Divide the insured's total income loss equally among all 3 policies and pay that prorated amount from each insurer. Option C. A benefits from each policy in the order they were issued, without reviewing the specific coordination of benefits provisions in each contract. Option D. Determine the primary policy based on the explicit coordination of benefits clauses within each policy and applicable regulations, then have that policy pay its full benefit. The secondary policy then pays the difference between the insured's actual loss and the primary benefit, up to its own policy limit, and any subsequent policies follow this order. The correct answer is A. Calculate the total potential benefit from all 3 policies and pay the insured that sum, as they have multiple coverages. Explanation. Scenario analysis. This scenario is professionally challenging because it involves navigating the complexities of coordination of benefits, COB, when multiple disability income policies are in place for the same insured. The primary challenge lies in ensuring that the insured receives the appropriate benefit amount without overinsuring, while strictly adhering to the specific COB provisions outlined in each policy and relevant regulatory guidelines. Misinterpreting or misapplying COB rules can lead to underpayment, overpayment, or disputes, impacting both the insured's financial well-being and the insurer's compliance. Careful judgment is required to accurately determine the order of benefit payment and the applicable limits. Correct approach analysis. The correct approach involves a meticulous review of each disability income policy's COB clause. This typically requires identifying the primary and secondary payer based on the policy language and regulatory hierarchy. The primary policy pays its full benefit first, and the secondary policy then pays the difference between the primary benefit and the insured's actual loss, up to its own policy limit. This method ensures that the insured is compensated for their actual loss of income without exceeding the combined coverage limits of all policies, thereby adhering to the principle of indemnity and the specific contractual and regulatory requirements governing COB. Incorrect approaches analysis. An incorrect approach would be to simply sum the benefits from all policies and pay that total amount. This fails to acknowledge the COB provisions and the principle of indemnity, potentially leading to the insured receiving more than their actual income loss, which is a violation of insurance principles and likely regulatory guidelines. Another incorrect approach would be to prorate the benefits equally across all policies without considering the order of benefit determination. This ignores the hierarchical nature of COB as defined by policy contracts and regulations, which dictates which policy is considered primary and pays first. A further incorrect approach would be to pay benefits based solely on the date the policies were issued, without consulting the specific COB clauses. While date of issue can sometimes be a factor in determining primacy in certain situations, it is not a universal rule and can be overridden by explicit COB provisions within the policy contracts or by regulatory mandates. This approach risks misapplying the COB rules and leading to incorrect benefit payments. Professional reasoning. Professionals should approach COB situations by first understanding the specific COB provisions within each relevant policy. They must then consult applicable regulatory guidance to establish the hierarchy for determining primary and secondary payers. The process involves calculating the benefit payable by the primary policy, then determining the remaining eligible benefit from the secondary policy, ensuring that the total benefits paid do not exceed the insured's actual loss of income or the aggregate policy limits. This systematic, policy-driven, and regulation-informed approach is crucial for accurate and compliant benefit administration.